So we just recently had a huge historic day take place in the market, and when I say historic, I don't mean this in a good way, I mean this in a horrible, dangerous way, and that's because we recently saw one of the biggest drops since March 2020 COVID times.
No, God! No, God, please, no! No!
And when we take a look at the S&P 500, it is looking pretty bad since we're below some pretty critical levels. For example, what we see here is we're looking at a linear regression band as well as the 200-day exponential moving average, which, by the way, are just some quantitative ways to kind of chart the market, right? I'm more of a fan of looking at things from a quantitative perspective than a technical perspective. And for those that are asking, well, what's the difference, right? A technical perspective is a bit more subjective, right? We're looking at trend lines, etc., versus linear regressions, moving average, right? Those are things that are based on math, which are objective, right? And so you're plotting that, and what we see here on the chart is that we are significantly below the 200-day moving average, which is seen as very bad, right? We're in a downtrend. We're in a correctional territory in terms of where we are from a percentage standpoint year to date on the S&P 500, and we're below the second deviation of the linear regression band. And when you see the market trending significantly lower than those critical thresholds, that's not a good look. But it kind of gets worse over here. So when we look at the put and call option ratio, which is another quantitative way to watch the market, we are at extreme fear where we are seeing more puts take place rather than calls. Now, what's a bit concerning about this chart is that many market participants, right, smart money, right, institutions will tend to take a contrarian view once we're above the one, right? Like, just once we're there, that's when we kind of expect it to kind of be an overreaction, and that's the bottom. That's when it's time to buy. But we're still below that certain area on the put to call ratio, which means that there may very well be some more bleeding, which I think could take place for the next couple of weeks, and that's kind of dangerous. But I want to go ahead and talk about what are some pockets that you could go ahead and rotate to possibly take advantage of not seeing your portfolio drop down and kind of hedge a bit with something that's going up. Now, I'm going to go ahead and talk about that later on, but of course, I want to just mention that this is all pretty much taking place because of the recent tariff policies that have been, enacted by the Trump administration, which of course got even worse today when we heard of retaliatory tariffs from China. So it's actually getting pretty worse. Now, when we take a look at the S&P 500 equally weighted, which I often use as a proxy for market breadth, right? We see that significantly down as well. And so the main difference between the S&P 500 and S&P 500 equally weighted is, of course, as it's implied in its name, it's equally weighted, right? The S&P 500 regularly puts a lot more emphasis on those mega cap tech names. So think about Tesla, right? Tesla stock has been falling down a lot. And so with Tesla stock falling down, that's going to bring the S&P 500 average down. But when we take a look at the S&P 500 equally weighted, meaning all the companies have this equal weighting, it's also falling down as well. And I often use that within the Push and Profit Private Group as a kind of proxy to gauge market breadth, which means that when it's falling down, there's weakness in the market, right? You want to see the market going up and the equally weighted version of the market going up to show that there's a healthy market, right? But when we're not seeing that and we're seeing the inverse, well, that shows that we're in a pretty weak scenario. Now, President Trump recently posted on Truth Social that this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. He is always, quote, late, but he could now change his image and quickly. Energy prices are down, interest rates are down, inflation is down, even eggs are down 69%, and jobs are up all within 2 months. A big win for America. Cut interest rates, Jerome, and stop playing politics. Now, what's concerning here is that many economists all agree that tariffs are inflationary. Now, with that said, we actually did have Jerome Powell have a speech for today, and what we heard from him was not positive. In fact, this is what he said. He ended up saying, quote, "It feels like we don't need to be in a hurry. There's a lot of waiting and seeing going on, including by us, And that just seems like the right thing to do at a time of elevated uncertainty. Now, of course, this makes sense for the Federal Reserve to kind of put a hold on things because yes, we do want the Federal Reserve to cut interest rates and kind of put that stimulus kind of action for the market. But the problem is that could risk, us going back into inflation, right? Into this inflationary period. And with tariffs kind of in the picture, well, it makes sense that the Federal Reserve is like, whoa, 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 slow your horses. Maybe we want to hold off and try to gauge whether or not we absolutely need to cut rates if unemployment just skyrockets, or if we could kind of hold off. So a bit concerning, but what makes everything worse concerning, or rather more concerning, is the fact that JP Morgan raised its recession risk to 60%. Now, let me go ahead and just clarify this. They don't mean just domestically in the United States. They're talking about a global recession, which is far worse than just some typical short-term recession that we have in the United States, right? Typically, what you'll see on the Series 7, right, if for anyone who's taking the Series 7 exam in finance or works in finance, right? A recession is technically something that's measured when you have 2 consecutive quarters of negative GDP. We had that back in 2022. But what JP Morgan here is saying, right, the analysts at JP Morgan, they're expecting a global recession very likely to happen, especially with these new tariffs, retaliatory tariffs actually coming into play. But something I like to often look at is several different sectors and pockets of the market. And what's very concerning is that pretty much all the sectors within the S&P 500 sector are down today, right? They're all down. And on top of that, we're seeing this message from gold, right? Gold recently made new all-time highs. It was pushing up because people see gold as kind of a hedge for, inflation and uncertainty. And we actually see gold even falling down today as well, which kind of tells us a message that the uncertainty is far worse than what we originally expected. Now, where we are seeing pockets of opportunity, right? And before I mention this, right, make sure to hit that like button and subscribe to the channel if you haven't done so already, as it really does help out with the channel. But one thing I want to mention is that the pocket of opportunity here is within TLT, which recently broke above the 200-day moving average, which it hasn't done since December. And TLT pretty much moves up when long-term bond prices are going up and the yields are going down. And so when there's a lot of chaos in the market, we're even seeing gold fall down, an area or a pocket of opportunity right now is TLT or TMF, which is the leverage version of TLT, which, by the way, whenever it comes to leverage, right, I always say leverage can be very dangerous, right? So you want to be very careful when you're using leverage, especially triple leverage or double leverage ETFs, as they have that decay factor to them. I won't delve into the whole math of that. I'm pretty sure I've talked about that in many separate videos. I also break that down within the Push Your Profit private group. But, TLT or the leverage version, TMF, may be the area of opportunity right now as it's pushing up, breaking above the 200-day moving average, and everything is pretty much capitulating and falling down and likely to have more pain before we actually see that bottom, which I think could actually take a few weeks. Now, real quick, if you're wanting to learn how to analyze a company like a pro, then make sure to check out the Financial Modeling and Valuation Analyst Certificate that's offered by the Corporate Finance Institute, as it can literally take you from having no clue in what to do in Excel to becoming an expert at financial modeling, since it's going to go through building financial models from scratch, valuing companies and analyzing financial statements, all through a super structured format. Plus, having the FMVA certificate on your resume is going to help you stand out, especially if you're trying to break into a career in finance, as a lot of professionals at firms like Deloitte, Morgan Stanley, and Goldman Sachs have all taken CFI courses. But of course, if you're not trying to break into finance, the knowledge alone is really good if you're just trying to be an independent investor. But with that said, if you're interested, make sure to check out one of the links down below to gain access to all the certificates that you can earn with the Corporate Finance Institute. But with that said, let me know what your thoughts are on the current environment of the market and what areas of opportunity you're looking for, or what stocks do you have in your watch list ready to buy. Because just because, you know, everything's falling down, eventually it's going to be a great buying opportunity for a lot of companies that are going to be significantly undervalued from their intrinsic value, and we're gonna have a nice sale to buy. It's just you don't want to buy every dip, because the dip can always get dippier. But you guys let me know in the comment section down below. And before you guys go, make sure to check out this video right over here, and I'll see you guys on that next video. Take care, guys.